All right. Hello and welcome. You are here for the November 2025 job search and jobs report and inflation update. My name is Albert, founder of Albert's List. We're a job search, side hustle, and AI education organization, helping you become the most resilient professional you can possibly be. And that includes staying up to date with the latest economic trends and news, because if you don't know why your job search stinks, it helps to know why. And so, as you know, we've been doing this for a long time. If this is your nth time back and you've been here before, welcome back. Feel free to use the webinar chat to network, say hello, ask your questions. If this is your first time here, welcome. We cover economic trends every month, your questions, and we peer into the future to see where the market goes. And with us, and Dr. White, I'm going to be using your old bio here.
Oh no,
It's
I gotta send you a new
I know.
one. Oh no. You're like, I'm gonna use it anyway.
I know,
That's
yeah.
silly.
With us here is Dr. Reilly White, of Associate Dean of Teaching and Learning and Associate Professor of Finance.
Regular
It's new,
professor of
right?
finance. No.
I need to get your new bio.
I know, hold on. Let's do it. Let's do it. I gotta do this. We gotta do this thing. It's a new bio. No, I'll do you know, I really appreciate it. Thank you so much, Albert. But rather right, I am a full professor of finance. I just
Full
got a
Professor of
nickname.
Finance at the
And
University of New Mexico. And
and
he's a very important member of the Alberts List community because not only does he bring the insights that you need to know about what's going on in the economy, he's a supremely nice guy who is interested in all of your career success. And so if you need to know who he is, look him up on Google. He's all over the news for all the various things that he's done. He's written about everything from financial literacy to cryptocurrency to everything in between. And so, without further ado, Dr. White, I'm going to go ahead and hand it over to you.
you rock, Albert. That's the best bio ever. I'm gonna use that instead.
I like
Oh,
the Michael K. Here we have Reilly White,
Riley White.
interested grad student,
Man,
concerned economist.
joke's on you, Michael. I was never interested even as a grad student. So one of those things I've always been disinterested. No, I've always been
Here
interested.
we have Reilly White, soon to be doctor, concerned economist,
Consider
and
the doctor.
and city council gadfly.
That's okay.
All right,
Thanks.
have
Thanks,
fun.
Albert. Again, your professionalism is always appreciated at this in our time of need. Let me change the screen settings a little bit so you guys in the cheap seats can see this a little better. Because when I go to slideshow presentation mode, this will be a little bit more visible for you. As always, funniest kid in eighth grade. Melanie, I think I was the funniest kid in eighth grade. Everyone else was like, "Yeah, it was like this is Riley. What's he gonna do?" And and the humor's never changed. And as a consequence, humor moves on. But for a brief moment, it was a great period. Dr. White, most likely to write an essay interpreting Jerome Powell's latest press conference. Before Jerome Powell, I know what was I was writing, fan letters to Paul Volcker in those days. But in this situation, we've got the jobs report and inflation rodeo. Again, I am trying to avoid, I add a little bit of gender representation here, but AI won't have it. But anyway, here's what we got. So thank you all for being here today. As always, put your stuff in questions as you have them in the chat. You can also, if you're a little bit worried about the question, I will never shame you if you send me a private message question. You'll always be anonymous, and I'm always happy to answer those as well. So whatever you got, let's keep it going and let's talk a little bit about what's going on in the economy today. Albert's got a hard deadline in about an hour, so we're going to try to compact as much as we can in this space. We've got stuff to talk about, shenanigans, things. I've got a shameless plug for some policy changes I made at the end of this. But we're going to work through some of this. I want you to ask all the questions, feel all the questions, good ones, bad ones, terrible ones. We're here for it. And I'm so excited that you're here on this magnificent Thursday evening to spend it over here. So, again, maybe you're in traffic, you're listening to the melodic sound of my nasal voice. Or maybe you're at home. Maybe you're relaxing. Maybe you're trying to do this to get out of something else you're supposed to do. Thank you anyway. And I appreciate that. So let's talk about this. So, as you know, the jobs report has a little bit been iffy lately. So I've got to use ADP, the proverbial disregarded stepchild of the jobs report community. And the data so far has not been good. In November, we actually had a net loss of private sector jobs, and I'll explain a little bit about where those fell. Now, ADP, as we talked about last month, if you had a chance to hop on along with this, is one of two big jobs measure reports that we talk about. The big one, of course, being the Bureau of Labor Statistics. Since that data has been delayed, to, in a sense, we are operating off of ADP country these days. And ADP is useful and it does correlate well in the long run to the Bureau of Labor Statistics, but a lot of the individualized data often doesn't. So kind of floating in the dark, so to speak. Michael says, sorry, teach. Hey, the dog ate our BLS stats. That's absolutely right. Does it work this time? Doesn't work for me anytime. So job report, not stellar. So even in ADP, which is another jobs report survey where they take a sample of a population and extrapolate that to see how well the overall economy is doing. Bad news bears, particularly for professional and business services, a motley of different things that range everything from your accountants and your nimble finance folk all the way down to things that support lawyers, et cetera, et cetera. We're seeing a lot of high paid jobs are in this category. We saw a 26,000 job loss this month in ADP. Information, manufacturing, and financial activities and construction all down likewise. Where was the sunny spots of this report? So I look in the sunny spots, we've got leisure and hospitality, not bad, but low paying, and education and health. And by education and health, the sector also known as the sector that is full of huge overhead costs for a diminishing return. I feel, can I say that as an educator? You'll notice that we're adding jobs there. We don't have tech in this because tech actually ended up being neither particularly notable, being neither particularly high nor low. And so I'm going to cull some of that data from our Challenger report data, which talks layoffs, Michael. So that's a great question. Melanie says if we continue using ADP and BLS, won't we have to revise the data up down later? We will, but who's to know until we get that data coming through? And Melanie brings up a good point. As we get jobs reports coming out, they're often revised, the Bureau of Labor Statistics, ADP, in response to new economic data as it arrives. And so here you've got an interesting story. So we've put all these protective tariffs on our economy. What's it doing? Surely our manufacturing sector must be booming low. Our manufacturing contracts for the ninth straight month this month. Always a wonderful time to be alive. Now, we do have data, though, up till September in the alternative measures of labor utilization from the Bureau of Labor Statistics. And a lot of you had asked last time, we talked a little bit about the difference between the different unemployment measures when people say, when I'm unemployed, what does that mean? The most common measure that we talk about when we're unemployed is called U3. That's the total unemployed people as a percent of the total labor force. So unemployed means that you are looking for a job. If you dropped out of the labor force and you're like, jobs, and you're like, no, not for me. I can't do this anymore. I've got to take care of my children, or I've got to do something else, or maybe I'm retired, or maybe I went back to grad school. UNM graduate school, great place to apply. There's my plug. But the rest of this, prestigious and competitive online programs. The rest of you who end up looking and falling out of the job market end up not being counted. And so how do we deal with this? U3 is kind of a compromise number. And U1 is looking at people who are unemployed 15 weeks or longer, and all the way to so U1 is very strict. And then U6 is much less strict because it deals with things like total unemployed people, plus all people marginally attached to the labor force, plus total employed part-time for economic reasons as a percent of total civilian labor force. So that's kind of the gold standard for where we sit. So across the board, there's some observations we can make between September 2024 and September 2025. Now we know U3, the unemployment rate itself, has been ticking upward from about 3.9 to about 4.4%. We know that that compares interestingly. We don't see that same tick up in long-term unemployment. We see a little bit of it from 1.6 to 1.8 in U1. And we see some of that still in U6, the total unemployed from 7.3 up to 8%. Big numbers, but low by long-term historical standards. So are there other ways that we can look at this? And so because we're dealing with some delayed data, and I grabbed this chart as well, looking at the Bureau of Labor Statistics monthly change in non-farm payrolls. So they think Powell thinks that payrolls may be overstated by about 60,000 a month in summer. And when we look at this overall, we look at some of the numbers coming through, the jobs market is bleak. It is bleak in the sense that not only is the data being delayed and inconsistent, but most likely these numbers here are very low, is my anticipation, or perhaps even negative. And so when we bring this and put this together, we paint a picture of a jobs market that continues to weaken. But it's weakening for a bunch of reasons. And so obviously you've got the big elephant of AI out there. And AI is some of the responsibility of this, but it's not all of the responsibility of this. If AI didn't exist and we snapped our fingers and we're still working on Windows 95 machines, I think we'd still end up seeing some of these job cuts as firms look to be more efficient with the money that they're using. Now, Challenger. Now, Challenger produces a magnificent series of layoff-based information, and the best part of this rainbow bright chart that goes from 2009 to 2025. 2025 is the thick blue line in the middle. As you can see, just how many cuts we've seen in the jobs market overall since the beginning of the year, up through November, and so tracking. You have every other year, there's only 3 years that track above this long-term trend. And it's 2009, which, if you remember, not the best year. I call it the year that forced me into academia. Actually, that was 2008. 2020, we had COVID. And so then you've got those 2 years in your bucket since 2009 and a whole bunch of other ones. And look, 2025 is giving 2009 a run for its money, especially late in this game. We are seeing layoffs in significant portions across different elements of the economy, but it is indeed in tech. We are hampered by our lack of data. We're hampered by a lot of other information that we have to actually filter that. If you look at layoffs.fyi, in 2025, they estimate about 123,000 tech employees have been laid off across 257 companies. They estimate about 72,000 government employees have been laid off and about 183,000 total federal departures. And so that's a really big, really big deal. And if you look through some of the data that they have, again, I don't have it in front of me, but layoffs.fyi, you got a whole bunch of data I have it in front of me on my phone, but I don't have it up here to show you. But they talk about a bunch of they tell you where the layoffs are happening, the locations, and the size of the locations. And they're relatively updated. And it's a good kind of proxy for what we're seeing. Those are real jobs and real numbers. Now, on the other side of this, and this is one of my, I had a question. I got a bunch of fantastic questions from the audience prior to this session, and one of the first ones that popped to mind was this one here, which is they asked and said, "Hey Riley, what's the deal with online retail and online sales? What's happening? Do you feel tell me a little bit about what's happening so far with consumer data, and do you think, and how is the economy doing it all at all?" And so right now, things to think about when you think of the US economy, we're a consumer-based economy. We're an economy that buys stuff. This doesn't surprise anybody per se. We about two-thirds of our GDP is consumption. It is generated by the stuff we go out and spend. And last couple weeks ago, we had Black Friday, Black Fridays. We had a series of days and various companies coming out and offering sales and deals to incentivize people to buy things before the holidays. Now, this is a nice bellwether for us to ask, how well is the economy actually doing? Are consumers spending? We know consumer sentiment is down. We know that people are still spending money. So two observations, and I made these observations separately, and then I read a tweet that put them all in one from Adam Cochran, and this is kind of the deal so far. So Black Friday sales data, 9.1 increase in spending over last year. Look at all that money. We're spending money, right? This is great, right? And is it great indeed? Is that a sign to come? Have we crossed the hurdle? Is it sunshine, rainbows, and a magical Pegasus for us to hop on the other side of this? And indeed, it seems if you read that headline number, you probably thought, great, but dig just slightly deeper. There was a minus 1% in item volume from last year. Oh, maybe people are just buying more expensive gifts for their loved ones instead of that, wrapping in a comically large bow a 1987 Toyota Corolla for my spouse. Maybe I'm going to opt for that Porsche after all. But notice that prices themselves are up 7% higher, and customer bought on average 4.1% fewer items. Interesting. Higher prices, fewer items. But this is the really, dig a little bit deeper still. Let's embed ourselves in this onion, a canker, so to speak, an ill-conceived growth. We had an 11% increase in buy now, pay later use. 9% increase in sales, 11% increase in buy now, pay later. Again, a small fraction of those payments are buy now, pay later, but we saw a massive increase. And Klarna specifically, Klarna saw a 45% increase in volume. Now, I'm not here to shame people who use buy now, pay later. Everybody needs something some of the time. But it's really interesting to see. Melanie's already anticipating my Gilded Age, actually, not even Gilded Age, Dickensian, I would say, outlook with regards to this. That the buy now, pay later scheme is rife with potential economic issues in the long run. And so it's okay. Credit cards are manageable. They're fine. We just got people attached to the question of credit cards. We've got $6,000 of average debt across the country on individualized credit cards. Buy now, pay later. I don't have the money now. I'll pay for it later. Fixed terms, little loans, often a very compelling deal for a lot of retailers to offer, especially for higher ticket items, but often increasingly with not so high ticket items and lower ticket items too. And it is a constant temptation for buttons at all. And it really, really is a way, especially if you have concern about your consumption habits and you're tempted to buy certain things, even if they're for other people. Buy now, pay later is a very tempting scheme. But people are using it in much larger quantities than we've seen before. And as Melanie points out, I predict privately held debtors' prisons will be a growth industry in 5 years. You heard it now, Archer Prisons. Please invest. One of those things it'd be fun. It'd be like a happy little arch, and then just poor wretches who are behind jail. About 11% of all Black Friday spending was actually financed this way. 84% of purchases were financed by credit cards, whereas 67% of these consumers expect to not pay the full balance in the first month. These are shocking numbers. And I want to go to the right side and little good data about buy now, pay later from the Lending Tree survey. There's generational differences in the way that people treat this. And so if we ask you the question and we say, well, have you paid it late on a buy now, pay later loan? In fact, the majority of Gen Xers and millennials, almost millennials, 49% of millennials, say yes, they have paid late. Whereas older folks, Gen Xers and baby boomers, say no, they have not. Problematically, especially for the younger generations, we're seeing a reliance on these strategies, prices going up, people with already under challenges in balancing their pocketbooks on a day-to-day basis, taking on a lot of buy now, pay later purchases. And then often the fear is, of course, they either won't pay, can't pay, don't want to pay. And as a consequence, then we have for your personal financial situation is terrifying. And so all of this is a fear. And have you ever used buy now, pay later service like Affirm or Klarna? When asked about, half of people have so far, once, 2, or 5 times. It is interesting. You can use it once or twice, and it's not itself a negative or terrible thing, but it does present some problems if mismanaged. And if you are using it and paying it late, it is being mismanaged. Be careful, because this seems rife. If I have like seeds of things that can become crises in the future, this is one of them. And so this is going to be interesting how this pans out. So everybody's trying to keep up with the Joneses, but unfortunately the train has left. And then let's go for a little bit. So I like that data. So how do you feel about the economy overall, and how is this? I'm concerned about the average consumer breaking in the next year under an inability to pay, higher inflation in the economy, not higher inflation, higher job losses in the economy, even with steady inflation that eats into purchasing power. Wages have been okay. They've been tracking a little above where we thought they'd be. And as long as wages exceed inflation, that means more wealth, and that's good. But I see this also, especially with AI, resulting in aggravating some of the differentials in the inequality that exists, which is important to monitor, even if you don't believe that even if you are philosophically of the mind that you think that inequality is not a problem for society to grapple with. It kind of is in the sense that if it becomes too unequal, it becomes unstable. Very interesting to see what's going to happen. Older consumers know not to fess up on embarrassing survey questions, Michael. I like that too. So you're like, have you ever? I like that you're like, Michael brings up a good point. So if you're cruising and you've been around the survey juncture a bit and somebody asks you, have you ever paid late on a loan? You're just gonna say no, whether it's true or not. So you're right, Michael. There's probably, I don't think this has been rigorously studied. U.S. job openings and labor turnover data. So Joe Politano's chart, but some interesting data to help you kind of sort through the long-term trends. So when I think about the economy as a whole, we think about a lot of these different things. Hiring rate has gone down. Ask anybody here in Albert's List. Has there been more hiring or less hiring? People are like, there seems to be less hiring now than there was before. And we look at these single digit percentages. This goes between 3 and 5%. You feel that substantially when we went from 4.5 to below 3.5. The layoff rate has been ticking up ever so steadily. Like if I graph this in a line, it ends up being a slightly positive line. And then, of course, the quit rate, people quitting their jobs has dropped dramatically. And a lot of that, and you say, oh, well, isn't that good? Long-term jobs. People often cannot quit jobs for a lot of reasons. One of those might be fear or inability or perception of inability to get another job. That's not a healthy sign. Job openings rate themselves also down as well. So, when we think another way to look at this is Econ Berger's chart for job openings going all the way back to 2020. And if you look at the job openings rate in a 3 month smooth average, we're looking at the opening rate having reached its peak following the COVID-19 pandemic as people were hired back. And nowadays it's fallen to pre-COVID levels. And it's kind of stayed there. It hasn't fallen off the face of the earth, but it's down to significantly lower levels. Now, we also divide the market into different places. We look at hiring quits and layoff rates. Layoff rates, again, taking a higher slowly, not catastrophic yet. Orange, of course, in 2020 shot through the roof in the COVID pandemic. Quit rates are down and hiring is also down. All signs that we're weakening still in the economy. But this isn't a crisis in itself, it's a weakening crisis. So, what happens next? Is this the end of the world? Is this the end times? Should I stock up and live in a basement in Sacramento? Maybe, but not yet. But right now, the economy as a whole is still growing. And despite the decline we've seen in this, we've actually seen impressive GDP results. So right now, the Atlanta Fed produces something called the GDP Now estimated GDP. They take all of the economic models and compare it to the economic data that's coming out. And Sacramento's too expensive. Oh man, it's the thinking person's Bakersfield though. In the Atlanta Fed GDP Now's estimate, we are showing around or nearly, it was almost 4%, but about a 3.5% increase annualized for GDP in quarter 3. Now, that is a pretty good number, and it tracks comfortably above consensus or blue chip consensus estimates of where it will be, or where it would be. So, what is the cause of this growth in GDP? Is it we're suddenly more productive now with AI? What is driving the GDP growth that we've seen, while at the same time, we've seen such lack of growth in other sectors, particularly jobs. We know that I said that GDP is two-thirds consumer spending. It's also business investment, government spending, net exports, all important. It's an equation-driven model. And so all of those pieces are part of it. And consumption, as you note, has been rocking and rolling, but some of that being built on a dubious foundation, relatively speaking. Now, we look at the big companies that are out there, the Magnificent Seven, the total returns. Grab this data, Y charts through Charlie Bilello on December 5th. And we look at the returns of the market, and we've talked always about the Magnificent Seven companies. Maybe you work for a Seven company. Maybe you have an understanding of them, you utilize them, you operate with them, you appreciate at least over the last 5 years how dominant a force they've been, especially with regards to a lot of market returns that we've been seeing. However, this year in particular has been interesting. And as a note, the S&P 500 is up about 18%. Now we look, there's only two companies, Google and Nvidia, that are up above that amount. And then the rest of them are actually falling slightly behind, which is interesting. Microsoft, Meta, Tesla, Apple, and Amazon. Oh, disappointing those numbers. And another way to look at this, because I'm a big fan of multiple data sources looking at problems different ways. And so from Schroders, these show tech companies with no revenues or profits are flying, as are the Mag 7, and the rest are left in the shade. So using a slightly different platform, this looks at performance between the 31st of December and the 31st of October. If you're a NASDAQ company and you've got no revenues, rock and roll. So what does that say? So you're generating promise, and those revenues have to catch up to justify those prices. Unprofitable companies doing better than profitable ones at the moment, which is a symptom overall and long term of we call a growth situation in the economy. When we had the internet bubble as the exaggeration of this, you looked at a whole bunch of companies with the word internet attached to it. Nobody knew the difference between Amazon and pets.com. And as a consequence, you saw just an influx of money in these areas. There's a lot of reasons. Michael says, why do you think this is? What is the market pricing in? So the first is the market's hungry for sources of returns. And you see this manifested not only in the public markets, but also private equity and private credit, and providing opportunities. And a lot of institutional investors, where a lot of money has flowed, are finding ways to generate returns for their investors. So some of that's the natural process of finance. Now, why invest or build up companies that necessarily have no revenues? We are dealing with right now an AI-driven boom and an AI promise-driven boom. And one of the aspects to look at, in a debate I had in a conference with some colleagues fairly recently, was how is this thing going to shake out in the next few years? In particular, AI, of course, everyone understands AI, like everyone understood the internet in the 1990s, to be useful, functional, and beneficial. And the nature of how it makes money and who is going to make money from AI is really important. And so companies are out there making promises and claims. I suspect, Michael, that some of this is driven by a lot of technological promise across the board, and some of it is driven by without actual those results. And whether those results actually pan out or not is going to be the question. I sat, and I'll give you this. I had lunch last week with a venture capitalist, um, and we were talking about the market right now. And he says to me, like I've heard before from everyone, and now venture capitalists, if you work them, you know them. So finance people, we get to be a little bit negative at times because we remember the past. If you're a VC person, you're going to be like sunshine rainbows. Things have changed now. We're all different. And he says like three things that are like warning signs for any human being, but don't take it with a grain of salt. This is a VC person. You're not talking to your local community banker about this. This is what they do. Indeed, they have to. They got to be hype people for the companies they represent, or at least believe in it, and then be critical about it. They're like, AI is going to continue on forever. He said to me, I don't think the markets will ever go down. And I'm there, and I brought my a junior finance professor with me, and I went, "Do you want to take that, professor?" And then the third one was, which is great. I love when people say this time is different. That's my favorite. I love that one. Say it with me. This time is different. This time's different. It's never going to go down. And then he said basically that he was predicting simultaneously the markets are going up forever and AI is going to create an indefinite job loss that will affect us all. But there are barriers to all of these things. Inventing something and then creating a process by which they replace things takes many years to accomplish, even in the trajectory that we're in. Robert points out Amazon was operating at a loss and debt for many years around the year 2000. Absolutely right, Robert. And this is exactly the point I want to make. And the point I want to make here is that companies start up. But the question is, we had a whole bunch of companies that also operated at a loss in 1999 or 2000 that don't exist today because they went bankrupt and their business plans were bunk. So how do you know in 1999 what Amazon was, and how do you know what pets.com, of course, famous failure that went down the tubes as well? How do you know the difference between the promise of those companies? And our hindsight is perfect, right? We can see, oh yes, yeah, Jeff Bezos, the the sun shining off of his head was magnificent. And I knew immediately that Amazon, we invent for ourselves reasons that we buy things, right? Because that's the nature of human nature. We talk about the positive things. We don't talk about the negative things. I'm going to give you a whole bunch of positive things about me today. I'm not going to tell you about the day I had. It's not one of those things. But for you, that's exactly the point, is that the hard part is when you grow a market like this, there are winners and there are losers. And the winners are going to be the ones who pick the right horse. But the whole market goes up and the whole market's going to go down. And then who's going to shake out will be the people that actually create economic value. And that's the nature of cycles. And Melanie says, let's buy AI stocks with Klarna. That's so God, that's great. I love it. I'm gonna get that on a t-shirt, and that's gonna make my day. So let's talk a little bit about tariffs, because they're terrifying and or terrific, depending on on where you are, depending on if your industry is health. So right now, this was courtesy of Aaron de los Reyes, frequent Albert's List contributor. He came out and provided some data that from some document he sent, and this was really cool, and I appreciate this. So countries, rates, and notes. So a lot of current tariff rates are hitting right now, about to hit, or in some type of negotiation or negotiation status between them. And so when they ask about questions about how the economy is going to do, tariff factors into this, because a lot of the tariffs that we've seen have been either impartially enforced, not fully enforced, or they remain with some very interesting and flexible exemptions that are being negotiated right now. And the nature of how these tariff rates work depends on kind of is predictive of where we think everything from the manufacturing economy to the regular economy will operate. And I was reading another economist blog from a couple months ago, a service actually that provides this data, and they were making projections on manufacturing employment through the end of the year. And they were really bullish. They said, well, it's negative right now, but once the uncertainty eases, we expect that the economy will start building out. The longer the period of uncertainty and the longer the period of uncertainty lasts, with tariffs going up or down, it makes it hard for companies to plan. A lack of planning means caution on behalf of companies, from everything from hiring to everything else. So even if they do protect the manufacturers that are involved in these specific industries, and I went actually beyond, and you've seen this, there's a lot of new people here today, so you may not have heard this before, but tariffs in general are usually an economic loss. Reason is that you protect one industry and you get more layoffs in other industries that rely on those products or services. So in protecting steel, we might lose products or services on the other end. There are reasons, of course, to employ tariffs strategically, but widespread tariffs across the economy generally get passed down to consumers in meaningful ways. And that's one of the reasons that despite the decreasing economy, we've seen a remarkably robust inflation rate still cruising around 3%. And remember that although the Fed's target is 2% and inflation has been stubbornly high at 3%, driven by stuff like this, 3% is, you think, oh, not a big deal. It is still 50% higher than 2%. And extrapolate that price difference over time to notice those differences. Now, we are paying billions in tariffs. There's not a question about that. Right now, we're paying roughly about $350 billion or so. Right off the top of the deck, just about 1,000 and some change per person in the United States, man, woman, child, and other. And we've got a whole bunch of growth in this. For a long period of time, tariffs were very low. So right now, typically we're spending, if you compare it to, say, the pre-2025 era, we're spending about 5 times more in tariffs than we did before. So it's starting to show in some of these prices that we've seen even on Black Friday. And wage growth. Now let's talk about wages. Prices go up. Wages, do they also go up? We don't know. Let's take a look. So the wage growth has been a very interesting topic of discussion. For a period of time, we saw or typically see lowest earning wages were increasing. Now, this was not always increasing faster than higher earning employees. Now, this wasn't always the case. There's a lot of things that go into wages and also inequality and all that stuff that are different. But we found actually, interestingly enough, that despite the increase in demand for the lowest earners, we saw that after COVID, we laid off millions of people, many of them in service sector work that offered low wages, and then had to hire those people back. As a consequence, those people weren't around anymore because they moved on to other jobs. And as a consequence, Firms had to offer higher wages to attract employee talent. We saw wage growth the highest here immediately following COVID. Since that time, it's come down, and actually, in the last year, in the Financial Times, they've reported that higher earners have actually seen greater wage growth than lower earners, and that kind of exacerbates some of the questions around inequality. And we go now to the ratio of economic indicators to the coincident economic index. So this little ratio from FactSet is a nice way to look at there. People are all about, if I take this number and I divide it by this number, does it tell me we're in a recession, or is a recession going to happen? And there's a new one of these all the time, right? So we go back to the last series of recessions over the last 40 years. When we are in a recession, we see this ratio drop substantially. And we've seen that before in the early 90s recession. There was a recession, of course, in the tech bubble. And then we saw that, of course, in 2008, 2009 with the great financial crisis. I thought it was just an all right financial crisis, but they call it a great one. And then finally at the end in 2025, 2020, of course, in the COVID recession, very brief, we even saw a spike there. But since that time, it's gone down quite a bit. Now, leading economic indicators are indicators that are forward-looking by nature, and we're seeing this drop off. So again, this is more evidence to show that more economic news is negative than positive, and I would argue that while not damning in and itself, shows that we should expect more harder times ahead than we have now. We haven't crossed that barrier yet. Now, we've talked a lot about AI. Back when we talk about the markets, it's AI this and that. And one of the things we have to figure out is how to produce power for all the AI data centers that we've been creating. So if you've been looking around here, you'll look especially one of the operating and planned data centers here in the West, where much of us reside. We have actually a relatively small concentration of data centers scaled by gigawatt scale by the amount of power that they're using, the amount of IT load physically passing through them. Whereas you see massive amounts of demand in places like Texas, Georgia, and along the eastern seaboard. And so far, this is a question that we have to address because the load that's being added collectively to power is something that drives up demand for power. And so, one thing that needs to happen is an expression of greater energy production in different ways. Hopefully, clean energy, but energy that nonetheless to help ensure that the economic growth does continue. Now, the Fed came out with some fairly positive news. And you may have looked at this because we didn't know, because originally we were watching kind of we being the royal we, it's just me and you know my friends and my Klarna. We were just watching the prediction markets on the Fed. And initially, after the last Fed meeting, the likelihood of a December rate increase was quite low. Now it became, as time went on, it became quite predictive, like 90% or plus. We knew that the Fed was going to drop rates by about a quarter percent. And it happened. And so the Fed, of course, controls one rate, overnight lending to big banks. And the Fed wants to raise rates to help reduce inflation because raising rates makes capital more expensive. It means people spend less money. There's less of that money multiplier going around. And as a consequence, money supplies dry up, but inflation goes down. Yay! Things are more expensive. Certainly, loans are more expensive, but inflation goes away. And that's why the Fed raised rates so quickly after COVID. When the Fed wants to stimulate the economy, they lower rates. It makes money cheaper to buy, invest, and do other things with. And it was interesting to see how they weigh these things because we're still above the inflation target, and it's not really going down. We're at stubbornly about 3% inflation. The Fed's target is 2%. The Fed has a dual mandate, though: inflation at 2 and keep employment rocking and rolling. And they weighed this, and the significance are the Fed committee, open market committee, they weighed this. And they were weighing the risk to inflation driven by everything from tariffs et al. And they weighed the decline in the job market. In which do you think they said was more important today? And they said the job market worried them more. They accepted the inflation risk for the job market, but not universally. So if we look at dissents by Fed governors who were like, we're doing this, but I'm not liking this. We actually have some of the highest levels that we've seen since we have to go way back. In fact, I had to go way back into like the 90s to see dissent at this level. It's very, very uncommon to see Fed governors in this space use dissents in this manner. To the extent that we've seen six of them do, we have not seen since the mid to early 90s. And that's very, very rare, before the time when I started reviewing their minutes. And if you really want something exciting, you can read the Fed's report about this. They call it the Beige Book because, frankly, there isn't. They pick the most boring and in a most boring color there is, and they turn it into book form, so you can read it. It'll make you fall asleep. It's delightful. Print it out and give it to a gift to somebody that you hate. Now, on cumulative receipts, we've got a whole bunch of interesting data about the government budget. So, from the Treasury's point of view, here was what the Treasury looked at so far through fiscal year 2026, looking at outlays and receipts so far. So just starting in the first few months of this year. So outlays are what we spend, receipts are what we bring in. And of our 740 billion in receipts, almost half of those are income taxes. Social insurance and retirement make up another 260 billion. And then you've got customs duties, corporation income taxes, excise taxes, estate and gift taxes, and miscellaneous other. And then on the big side, on the right side, you see how we spend that money. It's Social Security, Medicare, healthcare. Also note, why am I showing you this chart? Look at number two. That's the second biggest outlay function that we're spending money on right now. That would be net interest on loans for our national debt, about $180 billion. $180 billion equates to roughly, it is almost half what we bring in an aggregate to our economy from the individual income taxes alone. That's a big number. Now we know the debt is very, very high. And I get asked a lot of questions, including recently, about is the debt a problem for now or a problem later? It's a problem because it's siphoning money away from other things. And right now, you'll notice that we're still running a deficit to the tune of about $500 billion, which is a lot of money. and so and so when we spend to finance a deficit, we issue bonds, we pay interest on those bonds, and our interest payments go up. And so the government has an interest in keeping interest payments low to assure the creditworthiness of our of our country. But in the long run, while not a problem overnight today, it very well could be a few years down the line. And it is something we need to watch and get a hold of. Unfortunately, there isn't a political party with a good answer to this right now. And it's interesting to see what will happen. Something will, certainly in the next 20 years. Be it from some reform that, from instance, that causes our this or bridges this gap in a meaningful way, or will be in a really challenging spot as we approach the future in this. So again, going back to the wage side again, I should have actually put this next to the other sides, but I liked it so much and it was different. Let's go back to wages for a second. Lowest earner wages, another way to look at this, also fallen drastically down below even upper middle, lower middle, and highest earners. So, lock-in rates. So let's talk for a second about mortgages. And mortgage rates remain persistently high. Right now, we're still cruising at 6% plus on 30 years. While not high by long-term standards, they're high by the relative expensiveness of this market. And because a lot of people have locked in interest rates that are often 2 or 3% lower than prevailing market rates right now, or even more, they're not moving, which means people are locked in. Versus right now, we're in a high lock-in environment. And for mortgage rates right now, according to Freddie Mac, according to other people, we expect that mortgage rates would have to fall by about 2% for this effect to disappear and the real estate market to get healthier. Now, some of that can be driven, in fact, by lower rates. So if rates drop in the long run, but lower rates will drop in response to stimulate the economy, and it usually implies that you need a downside economy to recognize that growth. And so what pans out here is very, very interesting. We haven't had such an extended period of locked-in rates since the 80s, and that's been an extraordinary time. And one of the reasons why we're not seeing a lot of movement in the real estate market right now. So I'm going to give you a self pitch here. This is one of those things, and heck, I'll just talk about it anyway. So we've got a few things on deck. So this, about a couple months ago, I started working with the city of Santa Fe, New Mexico, on developing a structure for their minimum wage policy. So I looked at a bunch of, I produced six different models for the city. The one they liked and the one they bid on involved a 50% CPI and a 50% two-bedroom HUD index model. In other words, a model that tracked minimum wage based on the price of real estate in town. Why does this matter and why do you care? Why do you care? I live in the Bay Area. I don't need minimum wage. Why does this matter? And all those things. Let's talk about it for a second. So Santa Fe is not so different, despite the fact that we're full of also California people and all kinds of shenanigans and fun. And I even so I was interviewed by the Associated Press for this, and I even got on the news in the San Francisco Chronicle for this. In our unique proposal, what we're doing instead of doing it to CPI like every other city and town across the country, CPI in fact is 40% real estate. We tether it even more towards the single greatest expense in Santa Fe. Santa Fe, of course, has very expensive real estate in New Mexico by New Mexico standards, cheap by California standards, but a house is double as expensive, pricey here as it is in Albuquerque. And as a consequence, you see the same sort of issues. People unable to afford housing and a lot of other issues at stake. It is an interesting and divisive topic, and I'm going to explain to this why does Reilly White, an alleged economist, be in favor of an issue and looking at the minimum wage? And there's a lot of discussion about what that meant. But if you look at what this meant, the city has one factor that is egregiously expensive, which is housing. Everything else is fairly cheap. Retail expensive things are tracked with national averages. We look at all the expenses across the city, it all tracks with national averages. The unique factor that makes it expensive are apartments and housing. And because of that drive, and because of this flight we've seen of lower income folks leaving the town, we built a wage that is unique across the country. And there's me. I'm in the background, ominously, over the mayor's head talking about this. But this is a really, really interesting um, project to be a part of. And I don't think it's going to be like influential. It could be reversed in a year and it'll be fine. It'll be just a thing that happened. But it's good. And I was pleased to be a part of it. And, when you do something, I encourage you to do this as well. I think there's hesitancy among academics in particular from engaging policy issues. But you can do fun things like this. And that's what I tell people. And then you get on the news and then you get hate mail from people who are like, this is going to kill my business. And I show there's no evidence that it's going to kill your business. And then I talk about all the evidence and then people stop talking to me. And that's what happens in these situations. Even got fan mail from Berkeley, which was exciting and also terrifying. But we've got this as well, and that covers the main points. I got a couple of bonus slides here. State of AI, why is housing expensive? But before we get into this, and I always welcome you to contact me or connect with me on LinkedIn. Happy to answer any questions that you have around those things. Hurry up off and stay on account of Albert's imminent departure. But I want to address a few questions that I had here. In particular, I'm going to access my Albert's list. Let's see, my wonderful Albert's list um, email here on my phone and make sure I address this. So I talked about the economic perspective. I have a good question here about navigating the job market at 62 amid age discrimination. So one of those things is really tricky, right? So there are a couple ways you can trick the market into this, and I'm going to spitball on this a little bit. And so if you're in a person in their 50s, 60s, 70s, you've likely encountered age discrimination in your workplace. You know that glazed over look, people looking at you saying, could you still do this work? Meanwhile, you're the only person in there with enough experience to justify or explain what's going on. So if you position yourself as a fractional executive, basically, you can argue that you're a leader without the same long-term overhead. That stuff is in demand. So if you can go off and say these things as a consulting role, that's excellent. I think you have unique assets, especially that you can leverage, especially if you're 62. You've got crisis management ability. You've survived through numerous economic cycles. You've got governance experience, mentorship ability, all of which you sell and you highlight. You're a people person and a people pleaser, but you also have the experience to back it up. I think you look at target individual sectors that value things like tenure. Healthcare does. Higher education, we really love that. If you have somebody who's 62 and wants to teach classes, come on down. We're going to put you on our arbitrary Rolodex of adjunct hires, and you're going to be right there. I'm just kidding. We don't actually have an arbitrary Rolodex. That would be it's not in our budget. Arbitrary, yes. Budget, Rolodex, no. Government contracting and professional services are also things that you could look at. Now, holiday spending we talked about, up or down, we saw that it was up, but for all the wrong reasons. We saw strategies for people struggling financially in this economy. That's a good question. So first of all, one of the things we are a consumption-based culture, so this will sound like a bizarrely conservative fiscal gesture, but build liquidity. Target a 1 or 2 month emergency fund. Even in small increments, getting there is helpful. You need that nest egg. You'll think better, you'll sleep better, you'll feel better. Melanie, local government hires a lot of over 40s. I agree. I love working with local government for that reason. They're great. Everyone's seen things. I've seen things. We talk about the things we've seen. Reduce fixed expenses, housing, things like transportation, subscriptions. And this is passe. Make sure you've got that budget down in your mind of what your expenses are. Know how to live on as little as possible. And I don't mean that in the patronizing way at all. We've all been in situations at times, and I used to live in my car when I was 18. It was actually a 1980 in the 1980s Corolla, Toyota Corolla too. It's terrible. And if you're in a position right now where you're looking in situations, make sure you can double check and ensure your fiscal house is in order. I think low cost programs offer some opportunities for upskilling. This can be things like some of the MOOC type stuff, but also like Coursera, Google certificates, things to reach these higher paying or at least more resilient fields, stand out from the mix. It's enough to say avoid high interest paying debt, refinance or consolidate early. Don't do those buy now, pay later. Yeah, at least there might be a couple if you want to play with it and try it. That's great. Why have the headache? Just do it. Do it on a credit card. Pay off the credit card every month. There are things you can do about it and double check. I think there is also a bigger question here too. When you're struggling financially, it's not a matter of making a budget and making this happen and doing strategies like this. You know all this. You're surviving. You're a survivor already. I think one thing I would say in the soft factor is don't give up hope. Don't lose that ability and don't lose that ability that very when you're at the nadir of your life, it is very easy for you to enter a very negative headspace, to spiral, to fall into depression, to do all of these things. All of those are very rational and validated responses, and you have to cultivate a fire in yourself, whatever that is, to be better, do better, improve, do something, and become a doer rather than somebody at the whims of their fate. And when you have nothing to lose, you have also the benefit of being able to risk all the more. And I think take the risks you wouldn't otherwise take in situations like this. Be smart about them, research them, do them, seize the opportunity as it presents itself. What happens to people who fall off the radar after 6+ months of unemployment? So we shift them economically, fiscally, spiritually. We shift them into a category of long-term unemployed, and that actually reduces official unemployment counts. And many might reenter through things like gig work, like part-time roles, training programs, other things like that. But there's policy risk that's attached to this. So attachment to the workforce declines sharply after 6 to 9 months period, which means that lowers long-run earnings, and it also makes it trickier to make that money back when you're rehired again. And it also has really, it's tough to explain in your resume. What happened there? Well, I was unemployed for 9 months. That's hard, but don't worry about that so much. I think in many cases, filling your career with jobs, opportunities, upskilling work, gig work, that kind of stuff, all of which is beneficial. Areas of economic growth in 2026. So we're going to see this. We haven't popped that AI bubble yet. We're still rocking and rolling. AI-enabled productivity tools, I think human AI collaboration rolls all the way. Healthcare, aging population, shortages of personnel. What a mixture of fun. I still expect that to continue to rock and roll. We've got green energy, grid modernization. I know you're like green energy in this economy with this president, still important. Literally, We're using energy all the time. We're going to need more energy. If you're producing energy, be it from any source, that's great. Why? Because it's cheaper now to produce solar and wind power, even without subsidies, than it is some other forms of power. But we're going to need power, power, power. Skilled trades, I think, are also going to be in demand. Construction and utilities, even though construction's, up and down. It depends on the type, but that's why the skill of that trade matters. Cybersecurity, I think, data governance, compliance. I'm seeing not a lot of detraction from compliance in my neck of the woods. Maybe you are. Albert says, when will this bubble burst? And David, to the follow-up question to that, is it really a bubble or the purchasing price of the dollar falling? Oh, snap, snap. So it's interesting. So what are the symptoms of a bubble? So David, one of the books I just read, which has been fascinating and not exactly analogous to today. I know it's going to be overhyped that way, and you've seen a lot of it. It's a popular book. Andrew Ross Sorkin's 1929, right? Talks about the financial crisis. It's not like the world's best book that I've ever read, but it's okay. It's solid. It's a good reading. So you argue in this sense about when is a bubble a bubble? How do you know this? Or is it the purchasing price of the dollar falling? The price of the dollar is falling, and that in itself is so. What does that mean when the dollar falls, right? So the dollar was very high for a very long period of time. That made importing stuff cheaper and exporting stuff on our side more expensive. The dollar has fallen. When the dollar falls, it makes our exports cheaper for other countries. But because of tariffs at all and converse tariffs that have been placed on us by other countries, we haven't seen really a corresponding increase in that size. I actually don't think the purchasing price of the dollar is really to blame here for the AI situation. I think AI, why does the US attract money? Because we have a deep diversified market. It's safe, we have rule of law, and we have clear securities rules in it. So when we attract US money, we attract international money. Now, if you want to do it this way, if you want to put your money in a different country, you put the money from international sources, which one might be one of the things you're getting at too, is you want to put it in a country that gives you a higher interest rate, that has higher expected returns. The US is lowering interest rates right now. There are other countries and other situations that you can get. We've benefited by an influx of capital because of the diversity of investments we had, our ability, our high interest rates that we've had over the last couple of years. And as people remove that capital and move it elsewhere because they're worried geopolitically, they don't like us, or one reason or another, we're going to see the value of that dollar drop. Now, AI, on the other hand, represents the question of is this, we know it, it's valid, it increases productivity or performance. We can use it in a bunch of categories. It has the symptoms of a bubble. Okay, all right. Now I see what you're saying, and let me get out of this, and I will counter this uh, with a few things actually. So let's so David came to rock and roll, I see. So let's rock and roll. You're not going to be appeased by a simple answer. Let me get you something else to chew on. So David says it's been falling since 1971. Inflation grows at a compounding growth rate. The supply money growth, and we continue to grow the debt ceiling. We continue to grow the debt ceiling. We continue to have all those things. The pressure on money has been strong, but the dollar hasn't. I mean, the dollar's value since 1971, if we're talking about removing the gold standard, that produces one thing. But one would argue that, let's look at the Fred rate here. Bump, ba-dump. And so one of the ways we can value the value of our dollar, quote unquote, it is more complicated than it seems. And in fact, and let me get some numbers out there, and then let me change my share screen a second here. Let's go down a little bit. And I'm going to do a little. Bear with me here. I've got 85 windows open, and I'm just going to change my display back to normal. This will be a little bit tougher to read because I've got this widescreen monitor that minimizes my slides a bit and has this adverse effect on my sharing. So bear with me. So one way you can look at this, how valuable is the dollar? We can use something called a dollar index, which looks at the dollar relative to other currencies and other things. And what we've seen, and if we follow the dollar index, and there's one that's out there that only shows since 2006. Now, the dollar reached really a local all-time high in 1985, David. And this is a very interesting story because it's a fascinating. It resulted in some fascinating hedging decisions on behalf of companies. So the dollar index relative to other currencies has been predictively and upwardly high for some time. It shot up even at the end of last year even significantly so. But since that time, since 2006, even the broad-based dollar interest index is coming in at a stronger rate. And what is the value of a dollar? Here, I'm referring it relative to other currencies or other large and wild traded currencies that are baskets of currencies. And so the evidence is that locally we're seeing the drop in the dollar, but it's not really the case that the dollar been has been in like a free fall per se since 1971. It's comparing trash against trash. Yet at the same time, it is all currencies. I can trade shiny rocks with you. I can change actual dollar bills with you. Currency is whatever we agree it to be. It's just something that exists. It exists within our minds anyway. Shiny rock, piece of paper, gold, something else, all of that's part of it. And that's part of the things. Exactly. Fiat, from the Latin word exactly, from Latin, which of course alludes to the freeness of the an untethered nature of free floating currencies. So it is that way. And so there are other currencies. Other currencies are even worse than the dollar, trash against trash. That's fine, but it is still the currency. But we can't, if you're looking at the value of gold going up or gold silver going up, we usually view that as a factor of economic uncertainty, of which we have great amounts right now. And that's also part of the picture. Albert says QE is restarting again tomorrow. Is 2026 going to be the last year where most stocks will be able to afford home stocks or crypto? Is the train officially leaving the station? I don't know if it's leaving the station. I do have concerns broadly about the economy right now. I think it does stand to reason that it will be a challenging period. I think so. Related to that question, I have another question here that says, given recent AI related layoffs, who's next? At risk, I think really repetitive knowledge tasks, administrative coordination and entry level analysts, all that stuff is rough. We're seeing that in the upward tick in hires, even for our own graduates. More secure roles, I think, come down to the things that matter the most, right? And back when I was a kid, what was my comparative advantage versus other children? What did I walk into a party with and start rocking and rolling? Was it the sparkly personality? Was it my humor? Was it my razzmatazz? Maybe. But what really impressed people, I think, was fundamentally, and I got a question I just saw in the Q&A. I'm sorry, anonymous attendee. I'll grab that one too. I just saw that now. Was that I thought was memorizing statistics, population data, all this stuff. I used to love it. When I was 8 years old, they'd be like, ask me the population of this place, and I'd tell them because it was great. And then the internet came around. It was widely used. I didn't lose my skill set. I changed the way I delivered it, right? And then suddenly I could do other things. It would be head math. I'm converting numbers. I'll do Fahrenheit to Celsius for you, whatever. And then they invented the phone. Who needs that when people are carrying around computers in their pockets? And then it comes down to you adapt and form these relationships, right? And so the things that tasks that AI can't address right now, when you blend human judgment with AI tools, things like project managers and consultants and healthcare professionals, you're dealing with something that makes you a human cyborg for productivity in the future. And you're going to be around skilled technical traits, in-person services, executive decision making, creative leadership. You gotta factor in a bunch of data. And I know promise is great. I work in academia. I want nothing more than to be revolutionized by a prompt where I write it and it spits out a Journal of Finance ready publication. We're not there yet. And I know people argue, be like, yes, we are. I'm like, no, we're not. Trust me. I keep trying every day. And every time it comes back and it's there's not a service out there that provides the level that of detail. But will there be? I hope actually, but not right now. So anonymous attendee approximately an hour ago said, Matt Grossman of Wall Street Journal reported on 12/7/25 that the administration will not publish its October report in wholesale price inflation, saying it will roll these figures into another delayed report due November. Thoughts stating the obvious. You're absolutely right. So any delayed data is bad data. That reduces the visibility into real-time labor trends, higher uncertainty for policymakers, and Fed decisions have to rely on private data, which increases the short-term volatility. I don't like it. Thank you, anonymous attendee, and I appreciate you asking this. That's amazing. Thank you for that question. On the docket, what else we got cooking? So, given AI regulated loss, we talked about that one, and they talked about that one. I think that's it. That's all I got for Albert's list questions. Anyone else have anything? What's going on? Thank you for sticking around. Oh, David's got some Basel 3.
I feel like I want to ask you about 2026 predictions in January when we do it. So
Okay.
I
Hold me
think,
to the fire, right? Be right or be wrong, but be confident. Let's do it. What do we got?
did your predictions for 2025 end up
No,
passing
didn't I
muster or
hedged
no?
it? Who remembers my predictions for 2025? Do we have a
It's in a YouTube video somewhere, but
I know I gotta analyze what I did. So I'm talking about so I would say I mean I'm still looking at economic weakening. What was my well I'm interested in my recession percentage. We didn't actually hit a recession this year.
yeah.
And GDP growth has outperformed where I thought it would be. So wrong about that, which is good. So I think that this job market situation where the job market is under stress, I think consumers as a whole are showing signs of stress given the credit, the 90-day delinquencies, I think other issues of concern. And if we pull back some of that credit size of things, we're going to see some negative consequences, and that's a big deal. And so, what are my predictions this year? It depends. So, I mean, if left to our own devices and there's no crisis, it will be kind of a managed. I think GDP growth will be positive. I'm going to say let's say 2% next year. So that implies a non-recessionary environment. I think we'll end up with a jobs market that will be 1 month showing positive numbers, 1 month showing negative numbers for the next few months. And I think that economic uncertainty is going to be the name of the game. My concern is the wrench in this is geopolitical uncertainty, other issues that might throw us off. If there's a war, an issue, or something else on another side of the world, this can have adverse economic consequences. So for January, I'm looking for, with any jobs data numbers, that the numbers for the holiday season remain positive. I think it's 50-50 positive negative on ADP, but I don't see us falling off the face of the earth anytime soon either. So it's a really good question. What do you think, Albert? What are your projections?
Oh gosh, I don't even know anymore. I feel like even if we head into a recession, that the Trump administration will do anything it can to juice the markets in however way. And even
Yeah,
and this will be especially true once Scott Bassett or somebody similar becomes Fed chair in May.
you're absolutely
We
right.
may have no numbers to trust anymore at that juncture.
I'm concerned about transparency. I'm not going to lie. Like it's not a
Yeah,
matter of this. You can't hide it away. Like
yeah,
Argentina did that game for a long time, and that got him Argentina. So the problem is you've got to really think through this. Transparency is good, and you're thinking about a whole series of consequences that'll happen if we don't preserve that.
yeah,
And it's not like they're testing economic theories that have been challenged repeatedly, and there's ample evidence to show they don't work well. But why continue with them is my question. At what point do you reverse course and say, let's try something else? Like,
exactly.
I'm an administrator, and I'll tell you, I think all day of plans to get people out of tight situations and save face. That's literally what my job is most of the time. Professor X, I see you've committed these heinous crimes. My suggestion is we follow process XYZ. Everybody wins, and it's good. And that's what, no, ooh, I get the sweats. No, no heinous crimes. That's exactly what it is. Oy vey, indeed, Elise. Oh, man, I'm going to
All
tell
right,
you.
well, I've
I
got
know
to
you got
wrap
to
it up
go.
here, but
You got to go, Albert. You got to go.
final thoughts for job seekers. I realize it is December 11th. Nobody's going to be really, I don't know, maybe somebody hires between now and January, but and the 1st of January, but like final thoughts, like what are we looking at? Is it the same message you've been peddling all year, or is there something different?
So, few things to watch. Consumers under stress, number one. That degrading consumer habit, we saw it before a year ago. We're going to see it continually. I don't see us returning. So, here's the deal I can't make a positive projection in the economic, meaning that I can't see us rocking and rolling with all the things I want us to see unless I see consumer health improve. Every time before we hit up in a run up to a boom, a run up to a positive economy, you see increases in consumer equivalent. My hope is, even though wage growth has been on that downward trajectory, if wage growth remains above inflation, the key point, people get wealthier. I'm more optimistic about the economy. They get ahead of their bills. If it doesn't happen that way or wage growth remains steady, and inflation remains persistently at 3% or more, we're in a situation where I'm much less confident about our economic trajectory. There is fears ahead, but there's nothing individually that'll throw us off the rails other than a decline in investor confidence around things like AI et al. Once more data is revealed. But that might be this year, it might be 4 years away. But let's see what happens. And you guys, as our tech experts, will know more. But come and join us every month at Albert's List for more of these fun shenanigans.
All right, wonderful. Well, Dr. White, another successful year of having you here on this webinar. I hope everyone goes home with their brains feeling a little bit bigger and a little bit more informed about where they are going towards the future. I want to thank you all in the attendee aisle here for joining us month after month as we really try to figure out this whole entire higher economy. And so I want to wish you all a wonderful, happy holiday season with whatever you celebrate and an extremely prosperous new year. And we'll see you here back in January. You can see a calendar list of all of our events on our Eventbrite page and Meetup and beyond. And until then, take some of this economic information, use it at your holiday party, and we will see you all soon.
Thanks,
Thank you
guys.
all, and goodbye.
Good luck, everybody.
Good
Happy
luck
New
to everybody.
Year.
Bye, and happy holidays.